Will we see an MF Global repeat with the news from PFG Best? We'll get Jim Wyckoff's thoughts on Technically Speaking right now. Good morning. As always, happy Tuesday to you, Jim.
Good morning, Danielle. It's nice to see you also.
Sour note today, right, Jim, with the news of PFG Best. Will we see an MF Global Part 2? And I know this is a story you hold close to your heart.
Yes, indeed, Daniela. My office is about 2 miles from the headquarters from PFG, and I know a lot of people there personally. My daughter used to work there, so it does hit very close to home, and it's a sad situation. Developments are still new and unsure, so the bottom line is it's just another sad day for the futures industry when we have developments like this that give us a black eye.
Right, Jim. Thank you so much for those thoughts. But now, looking at the gold market today, in your commentary, you stated that we are seeing firmer gold prices, but more choppiness is to be expected.
Right, Daniela. We are seeing a bit of short covering, a bit of bargain hunting, arguably even some fresh safe haven demand coming in. But the market is just in a choppy and sideways technical trading range. As my friend Peter Hugg from Kitco said, it's probably the start of the summer doldrums. And I agree with that. So we're going to see more choppy and sideways trading until we can bust prices out of this trading range that is bound by strong resistance in the August gold futures at the 1642.40 level. That's the June high. And then the recent low of 1547.60. So the direction in which prices break out of that range is very likely going to be the next trend on the near-term basis for the gold market.
Right, Jim. And I spoke to Peter yesterday on For Pete's Sake, and he was telling me how last summer was one of the most wild summers he's seen in his trading career. How come we're not seeing so much activity this year? Do you think that's the case?
Well, I think, Danielle, in my opinion, last year is not unlike this year as far as fundamental developments, but last year they were newer to us. We were more sensitive to them. We kind of desensitized, actually, to the European Union events, some weak economic activity, and the marketplace has just kind of become numb to that stuff, and we're just awaiting some fresh inputs. And speaking of fresh inputs, the gold and silver markets are waiting for tomorrow's, for Wednesday's FOMC minutes results from the Federal Reserve.
Right, Jim, I think I do agree with you on your theory there, because we have had no shortage of news this summer either, but like you say, perhaps we've just become desensitized.
Right.
Moving on now, Jim, I did get a few viewer emails in regards to last week's jobs figures that came out, and they were a bit frustrated because they feel that they're seeing two differing viewpoints. Some people are saying it was good news for gold, others are saying it wasn't. What's your take?
Well, I don't think there's any single right answer or conclusion to be drawn from last Friday's jobs report. It was a weaker number, weaker non-farm payrolls number. That, in one argument, can say it's probably going to bring a quicker implementation of QE3 from the Federal Reserve. There's another argument that says, well, it was still not quite weak enough maybe to push the Fed into a soon move on QE3. You know, who knows? I think with tomorrow's FOMC minutes results, we may get some fresh clues. We've got an upcoming FOMC meeting in early August. We've got Fed Chairman Bernanke going out to Jackson Hole, Wyoming later in August. He may make a pronouncement there like he has in past years. So we've got some upcoming events from the Federal Reserve that I think are going to give us clearer direction on, just when or if this QE3 will be implemented.
All right, Jim, now it's time for your Wyckoff market rating system. What grade are you giving gold and silver this week?
On a near-term basis, Daniela, for gold, I'm rating the market at a 5. That's right in the middle of the road. We're seeing the bulls and the bears struggle for near-term price control, and neither one gaining much control. So those aforementioned trading range support and resistance levels are going to be important. If the market can break above the range, it's going to, the rating is going to go up, and if it breaks below the range, the rating is going to go down. Now for silver, I'm giving silver a 3 or 3.5. The bears are still in near-term technical control of the silver market. Prices are in a months-old downtrend. The path of least resistance for silver right now remains sideways or sideways to lower until we see some fresh technical strength. Now on a technical basis for silver, we've got some strong overhead resistance in September silver futures at last week's high of 28.44.5. We've got some solid technical support at the June low of 26.10.5.
On the topic of silver, Jim, I did speak with a few analysts who said following the FOMC meeting, it was the metal that was hardest hit. Do you think it is the metal that's suffering the most right now if you had to choose between silver, gold, platinum, and palladium?
Well, it's certainly right there. I would agree with that. But remember that silver, while it follows gold to a degree on big safe haven moves, gold is big brother. Silver does not have the safe haven allure that does gold. And when you see the raw commodity sector under some pressure because of uncertainty or some weak economic data worldwide, silver is going to tend to follow the raw commodity sector, whereas gold could be supported in the same time frame by some safe haven demand.
Right, and on that note, there was news coming out of China that we're seeing slowing growth there. Would that affect silver prices, Jim?
To a degree it is. It's affecting all the raw commodity markets, and to a degree it's affecting gold. China is a commodity consuming juggernaut. It's the world's second largest economy, and when you see a decrease in economic growth pace coming out of China, that's going to have at least a near-term impact on the commodity sector. But one thing to keep in mind, Daniela, even though China's economy is growing at a slower pace, it's still well outpacing any other world economy. For example, the past couple of years, you've seen 10 or 11% annual growth in China. Well, this year you may see 8%, or maybe a little more, maybe a little less, but that's still a very strong number. China, going forward, is going to continue to be a major commodity consumer, and that is a major underlying bullish factor for all the raw commodity markets, including the precious metals.
On that note, thank you so much, Jim. We'll see you next week.
Can't wait till next time, Daniela. Bye-bye.
And thanks for watching this edition of Technically Speaking. You can email me at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.